This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. I'm John Budden, and welcome to Money Talk. Well, it's a sad day for our American friends because they are remembering the horrific events on September the 11th, 2001, and offer our sympathy and share their sadness. Friday was a horrible day for stock markets. The Dow Jones was down 400 points at the close of business, and it may well have been set off by Fed governors' forecasts of imminent higher interest rates. Here's the lineup for today's show. We start with Dave Sally of the Ottawa Business Journal for an update on the Ottawa scene, and then we go to Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management, for my weekly chat. And after the break, to Tony Dwyer, who's Chief Market Strategist at Canaccord Genuity, and he joins our affiliate BNN to look at how investors should navigate through the market given the very sharp sell-off that took place on Friday. And he's in conversation with Catherine Murray. Then to David Prince, who's the founder and president of Harbinger Capital Markets Research, to discuss the negative impact low rates have had on the global economy and how slow growth is starting to affect Germany. And he's in conversation with Michael Hainsworth. After the news, my interview with Robert Lloyd George, who is the founder of Lloyd George Advisory in Hong Kong and a very seasoned investor in Far Eastern markets. And we conclude today's show with an important interview with Dean LeBaron, the founder of Battery March Financial Management, a venture capitalist. And Dean gives us his outside-the-box thinking on markets, and this is particularly relevant given the sharp change that we experienced on Friday. But first, let's go to Dave Sally of the Ottawa Business Journal. It is great to be joined by Dave Sally from the Ottawa Business Journal. How are you, Dave?
I'm pretty good, John. How are you?
Okay. Now, Dave, a firm that is fast becoming one of Ottawa's true tech giants continued its acquisition spree last week, while one of downtown's most recognizable newsstands announced it is undergoing a major rebranding, and a local grocery chain said the chance to sell wine will uncork a new opportunity to grow its market.
That's right, John. Well, let's start with local media technology firm Ross Video, which announced this past week it has bought two new companies. On Thursday, Ross said it has acquired Ottawa-based Covelos Technologies and California-based Abacus. Covelos makes media networking and processing products, and Ross CEO David Ross says the company will continue to operate as an independent entity. Covelos says the acquisition will allow it to continue growing with the backing of a larger partner. Abacus, meanwhile, develops video server and replay technology, and Mr. Ross says its products fit in perfectly with his company's focus on live production and will allow it to round out its solution set. Now, these are just the latest purchases for Ross, which makes technology that generates on-screen graphics for broadcasts such as the Super Bowl and helps advertisers find out what people are watching. In the past few years, Ross Video has acquired companies in Florida, Virginia, and Wisconsin, among others, and it now operates an 80,000-square-foot equipment manufacturing facility in Iroquois, about an hour south of Ottawa, and also has a large presence in the capital itself. Ross has more than 600 employees and annual revenues well into nine figures.
Meanwhile, a very familiar name to news junkies in the capital is being phased out as part of a major rebranding.
That's right, John. Many people who stroll along Elgin Street will know the name Mags and Fags. That's the name of the venerable newsstand that has been a fixture of the local retail scene for 35 years. But this past week, a new name appeared on the front window. The store will now be officially known as The Gifted Type, although the old name will still appear on some outside signage for at least another month. Owners Charlene and Krista Blaschik say the new name better reflects what their store sells and the direction they want to take it. The word fags, of course, is British slang for cigarettes, but while tobacco products once made up about half of the store's sales, They are no longer even offered there. The store has now shifted its focus to cards and gifts, which appeal to a wider audience and have higher margins than magazines, Charlene Blatchik says. She also says the store is building a growing market for hard-to-find magazines over the Internet, but the word fags caused it to be blocked by many spam filters, meaning it was time for a change. Ms. Blatchik adds she sees the rebranding as all part of the evolution of the newsstand industry.
And finally, a local grocery chain sees big opportunity in the fruits of the vine.
Yeah, John, Ottawa-based Farm Boy is one of several grocery chains in the province that will now be allowed to sell wine under new regulations recently announced by the Ontario government. Up to 70 individual grocery stores will be licensed during the first round and could start selling wine as soon as October 28. For Farm Boy, the plan is to offer customers, quote, local products they might not be able to find in the LCBO or other retailers, CEO Jeff York says. And while the margins won't be great, he says selling wine is a very good way to differentiate his chain from others while expanding its product offerings. The province plans to allow up to 300 grocery stores to sell wine by 2025.
And Dave, what's on the OBJ radar for the coming week?
Well, John, the always popular Mayor's Breakfast is back from its summer hiatus this Thursday. A joint presentation of OBJ and the Ottawa Chamber of Commerce. The event always draws big crowds to City Hall for some good breakfast and interesting conversation. This week's guest speaker will be Bruce Linton, the CEO of medical marijuana producer Canopy Growth Corporation. To find out more, go to ottawachamber.ca.
Well, enjoy the rest of your day, and we will talk again next week, 2 p.m., Sunday.
Thanks, John.
And now we go to my weekly chat with Matt Hendricks of Sprott Asset Management. I'm joined by Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management. Quite a day on Friday, Matt.
Yes, John. It looks like something broke and the markets went down in a hurry and actually have closed below key technical levels from 2015. So who knows? This could be the beginning of something bigger. The markets have been slowly inching lower over the last 2 or 3 weeks. But Friday something snapped, so it'd be interesting to see what happens tomorrow when the market's open.
Well, what it reminds us of is the fact that you need to have a good defense in place, particularly in the core holdings in your portfolio. And I thought that this week we should take a look at how John Wilson's enhanced strategy performed, particularly on Friday when the Dow Jones came down more than 400 points.
Yes, for sure, John. The S&P 500 yesterday, which is the best judge of the U.S. stock market, it's 500 different companies in there. It was down over 2.4%. John Wilson's enhanced equity strategy was down half of that. I mean, to be quite honest, John's strategy has been slightly underperforming this year, mostly because energy and gold really have done all the heavy lifting on the upside, which John has got a minimal exposure to. But I got to tell you, his fund is looking very, very good over the last month, especially as market's been going down here. We remain hedged for the U.S. dollar. We've got very attractive risk-reward on our stocks. And, for example, our charts tell us that if there was a broad-based drop, let's say Monday, Tuesday, Wednesday of this week, the market collectively is down 10%. Our fund is marked only to go down about 2 or 3%. And if it goes down even more than that, the markets, there's a good chance that our fund would turn positive because of that insurance component we keep in there. So John has been very, very patient this year. As I say, slightly underperforming his benchmark due to all the heavy lifting in energy and materials. But I tell you, if we're about to have a downturn here, his fund is where you're going to want to be for your core North American equity.
Well, investors have to stay the course with this sort of defense. And for listeners who want information on John Wilson's enhanced strategy, they can always be in touch with you. And Matt, could you give us your coordinates?
Definitely. I'm always reachable toll-free at 1-866-299-9906. And always remember to visit sprott.com. It's a great website full of great information.
Well, we'll see what the coming week brings, and we'll look forward to talking to you again next Sunday, 2 p.m., Matt. Thank you. When we come back, we go to Tony Dwyer, who is Chief Market Strategist at Canaccord Genuity in New York City. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
All right, well, with just 15 minutes left to go in today's trading activity, let's head to New York for a look at the markets. Joining us now is Canaccord Genuity's Chief Market Strategist, Tony Dwyer. Tony, good to be with you today. Thanks so much for joining us. It feels like an important day. It feels like things are changing with the sell-off and the rise in yields, rise in U.S. dollar. You see and say what?
Well, thanks for having me, Catherine. Well, it's kind of interesting. You know, yesterday you could say that everybody was looking for a correction, and it's considered natural, normal, and healthy to get a correction. Everybody believes that until you actually get one. So we're down about 2% today in the S&P, and you can see that a lot of people are really kind of getting very, very nervous. Indeed, it's actually, before I came in here, if you look at the advanced decline ratio, it's the worst that it's been since the low kind of panic day of August 24th of last year. So it's a real down day. It's a nasty day. Again, we've been expecting a correction. We turned neutral about 6 weeks ago in anticipation of one, and we'll be looking to take advantage of it as it plays out.
It's interesting you say that because some of the conversations I've heard with other people as well is that the institutions, that people do in fact want to take advantage of these down days, and it was interesting to see the markets kind of move off the lows. That's not the case right now, just so you know. Dow's down 342, right. S&P's down 2.17%. But why do you want to take advantage of the lows? Why do you want to buy back in?
Well, let me give you an example of why I'm not saying you got to buy the next tick. My buddy Jason Gofford at sentimenttrader.com, he's our partner. He just pointed out to me that the large speculators are at a record long position of S&P index futures at $65 billion. You got to unwind that before you start thinking about who's going to be a buyer. Large speculators or hedge funds, etc. So, you know, you've got to unwind those trades before you can really jump in. And we've got some indicators that we look for when we do want to get more aggressive. But again, the fundamental backdrop of credit, despite the weakness today in both bonds, which has created an uptick in yields, and stocks, the fundamental backdrop, I think, still remains pretty favorable.
Favorable enough for the Fed to raise rates in September, and it seems as though that's what the action is all about today. For some reason, over the past 48 hours, and maybe it was Draghi yesterday putting the floor in the market, saying, you know, we're not so convinced that we want to continue to lower rates, and that almost gives the Fed, I said this yesterday on air, it seems as though that gives the Fed a put or a good reason to be able to go and actually raise rates in September, not December, let alone not even happening in 2016, and everybody's reacting to that today.
It seems that way. You know, it's kind of interesting. The one thing I'd like to point out that most of the viewers probably wouldn't realize is the question comes out, how can you possibly want to buy stocks when yields are looking to go meaningfully higher, when the VIX is historically low up until today, and, you know, the reality is stocks are near a new high. That's what happened at Taper Tantrum in 2013. You had everything weakening at the same time. So how can stocks rally if you let's say yields go to 2.25%, God forbid, higher, right? In 2013, they went from under 1.5% to 3% by the end of the year. Following Taper Tantrum, when stocks pulled back kind of like they are now, you had a near 20% rally as rates went up. So to us, the key isn't whether rates are going to go up. It's what does that mean? It means the financials are going to do better. It means the economy is doing better. And ultimately, the market follows the direction of earnings, and that should be higher, especially if you have stabilization in commodity prices and emerging economies.
So, Tony, but if what you said happens and the economy is stronger, earnings will move higher, valuations will look less rich. So for our viewers today, what should they be thinking? What should they be doing? Should they be taking profits knowing that this could be a little bit ugly? Or do you stay in the game? Do you stay with those stocks you own because presumably things are going to get better in the economy and therefore just hold your stocks?
Well, the viewers really have to evaluate, you know, I'll give you the disclaimer that's absolutely appropriate. They should evaluate every decision they make based on their own personal decision. I think the last thing you want to do until you're in a recession, you always want to buy weakness in the equity market unless you're in a recession. We're not in a recession. And as frankly, I think we're a couple of years at least away from a recession. So as prices weaken up, I think you want to look at those stocks that you would have said maybe 2 weeks ago or 2 months ago, geez, I wish I bought that stock. That thing's really ripping, and I love the company. I wish I bought it. Well, you're going to get a chance to buy it. The problem is when corrections actually happen, by definition, they've got to have a perception of a fundamental change, and everybody gets scared. Again, unless you're going into a recession, which we're a long way away from, you line up those stocks. We put out a piece on Wednesday called, looking at the offensive bond surrogates versus the defensive bond surrogates. What's interesting today is typically on a down 2% day, you wouldn't see utilities, telecom, and staples underperforming. Those are the defensive sectors. But it's because rates are going up. So our call has been you want to look at the more cyclical sectors, the financials, the information technology, the industrials, and look for higher yielding stocks within those sectors so that you get a benefit of better economic backdrop and better yield.
Got it. Tony, great to have you on today. Thank you very much. Nice to see you.
Thanks for having me, Catherine.
Thank you. Talk to you soon.
To add to Tony Dwyer's sage comment on markets, let's go to David Prince, who's the founder of Harbinger Capital Markets Research.
Central banks around the world have turned to lower interest rates to kickstart global growth. That effort seems to have failed so far. Harbinger's David Prince is with us as we discuss that, and we look at Germany, the big kingpin of Europe. But I want to start by looking at the U.S., GDP, and its relationship with interest rates.
Yeah, I think this is very revealing. One of the things that the U.S. has discovered, and we alluded to it in the first section, but it's very clear to me that the lower the rates, the lower the rate of growth in GDP. And it's funny how people haven't referred to that. But it is interesting to note that what we've seen is a subpar performance out of the Obama administration from their inception, given the fact that it was the Great Recession. We've had pretty minimal type of growth in the years subsequent to that incredible decline. So we are seeing a further decline, and I mentioned that in the break, but the main point here is the fact that rates really can drag it down, and I can't emphasize this enough, that people are desperately trying to find income. But
as we look at the orange line there, and we'll put it up on the big screen here too, is that it looks like interest rates are a lagging indicator on U.S. GDP, not a leading indicator.
But what they do is if they stay in one direction long enough, it prevents them moving. And that's really the issue here that we're seeing with that chart is the fact that we've had this on hold relatively ridiculous low level of interest rates. So there's no ability because most of those higher coupons have now run off.
So do you think Mario Draghi realizes this?
Oh, I'm sure he does, because I think that's what's coming from the German pressure. This is what happened this week. So to lead into our German chart, so what's the big factor in terms of the German economy? They are primarily driven off of exports. Big machinery, that's their economy. And so what happened this week was a big decline in exports for the German economy. That happening, it was coincidental with many other countries having a contraction in overall global trade. That's not good news. And here's a perfect example. That chart really doesn't show it well enough, but you can see that very last stroke is quite a decline given the fact that that's the period that we had the negative rates in Germany for 10-year yield. That said, the Germans don't like it when they're in negative territory, and more to the point, they sure don't like it when they're starting to lose export growth.
So with July exports falling the most in a year, you can't throw any more money at the problem because you're already at negative interest rates.
And you need your other people to start picking up or else your economy is in deep trouble. And there's no real solution for them to solve an export-driven if there's nobody asking for their exports. So that being the case, obviously the Germans are starting to put more pressure on Mr. Draghi about his policy about aggressive. So I think that all fits into the narrative that we heard yesterday, which was that basically that may be it for a while, but we're really confused as to what to do next. We've bought stocks, we've bought corporate bonds. And the thing that I really didn't like this week was that the high yield market, both in the United States and in Europe, they went to a record high. That speaks volumes about the risk profile within a market. It's ridiculous.
That we're willing to take such high risk at
we
a
have
time.
to. That's the problem.
It's the only way you're going to get returns.
Correct. You're not going to be able to match your liabilities unless you take ridiculous risk.
Which then puts us in a situation where you have a black swan event and the sky falls on top of it.
Well, and that brings you to today. So now you understand exactly why this market gets so nervous. Well, every time it goes down, we get more buying because it's a great buying opportunity. Let's see what happens next week, because that's what's going to be very pivotal. If we don't get an announcement where they come in, which has happened every time, we've had a Brexit vote, What happened? Massive amount of liquidity that was going to be added to the system. The problem for the market is eventually it says that's not going to fix the main problem if we have no growth. And that's sort of where we are, and I think that's why this is not just something that's just flown and it's just a one-off type of event.
Do you think it is more likely that the Americans September 21st raise interest rates?
There's more likelihood now because of what Rosegren said this morning. I was stunned. I mean, he's a very left-wing guy, and he's very much a dove. And all of a sudden, for him to start talking about this really did catch me by surprise.
Is he a voting member this time?
He's voting. Yeah, he's Boston.
Yes, Boston.
But the point is that he is significant. You can hear a lot of the different ones, but they're consistent. This is a change. So I think that's why the market took it so surprisingly.
You're looking at the boats?
Well, then we had another event. I mean, obviously we don't have enough time for all this stuff, but the big one was the fact that we had this bankruptcy out of the South Korean company that's Hanjin, and I wanted to show you something as it relates to shipping globally. What we've seen is this really big decline in shipping companies and a lot of bankruptcies that we've seen over the years. As in particular, we got this big one today, which is only $14 billion. But the reality is it's been a way underperforming group. Part of the transports globally, and the major reason why the transports have been very much. But today, a lot of the stocks that survived, what we saw was tanking rates and all kinds of rates go through the roof because there are a few companies left to be able to ship the stuff that needs to be shipped. That said, we are left, though, with the South Korean won. And the fact that it's going down means that what you're seeing is it's taking fewer won to buy a dollar. So fewer won means the South Korean won is strengthening. The chart that's the white one is the shipping, and that's a better depiction of what's happened over the last couple of years with that shipping group. As you can see, even though oil prices collapsed, it fell off the table. Too much capacity. So by having some of these fall by the wayside being bankrupt, there's an opportunity that people are believing that the other survivors are going to make money. The reason I'm going to that end is we need to see the global export growth increase, and soon, or else we are going to see a bigger decline economically than what's now being forecast.
David, we always appreciate your time.
Thank you.
David Prince.
Stay with us, folks. After the news, we come back with Robert Lloyd George, who is the founder of Lloyd George Advisory in Hong Kong, and his perspective on global markets. And then to conclude today's show, we go to Dean LeBaron, a venture capitalist, and he gives us his perspective on how to survive and thrive in this very challenging environment. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
Well, it's a pleasure to welcome Robert Lloyd George, who is the founder of Lloyd George Advisory in Hong Kong, to Money Talk. How are you, Robert?
Very well, thank you, John. It's a pleasure for me to be on the air with you again.
You have been wandering around the world this summer, and you did spend some time in the west of Canada, and I'd love to hear your perspective on Canada vis-a-vis all these other interesting places that you study.
Well, I should confess that the reason I went to Vancouver was because my 18-year-old son has decided to become a forester and an arborist, and the best opportunity in the world for him was to start his career in British Columbia. And so I spent several days settling him in Vancouver, which I think is the most wonderful city. I was last there in the 80s interviewing the lieutenant governor. He was a Hong Kong Chinese who came over and made a fortune in real estate and became lieutenant governor. And it was very interesting at that time to talk about the influx of Chinese, which has now become much, much more important, and I believe is a third or something like that of the population in Vancouver. And so I think that's a wonderful endorsement of Canada's attractions to investors from around the world, especially from China, Hong Kong, Taiwan. And I went on to Toronto, and I again was tremendously impressed by the warm welcome which Canada gives to so many people from different parts of the world, which is quite in contrast to the United States. So I just feel Canada's got it right, and it has a very bright future in terms of attracting talent and capital from many areas of the world, especially from Asia.
And I think our politics are somewhat less volatile than those in the United States.
That's for sure, yes.
Now, taking a look around the world, we're post-Brexit. We've had lots of noise coming out of the Federal Reserve Board, and you have written a very good September newsletter, Investment Outlook, and let's start with your macro perspective on what's going on in the world these days.
Well, I quoted Maynard Keynes, who said the market is a weighing machine as much as it is a voting machine. And in the short term, it's a voting machine. But in the longer term, I think it has to reflect the real developments in the global economy. And what concerns me most of all today is what I see as the continuing slowdown in global trade. I was in Singapore in June, and we saw for the first time in 25 years, their container port was about half empty. So that was a pretty striking thing to see. And now we have Hanjin Shipping going bankrupt, the biggest Korean shipping company last week. And clearly there's massive overcapacity. The Baltic Freight Index is at an all-time low. It's bounced a bit since that bankruptcy because, of course, a lot of capacity will be taken out. But I think it's a much bigger problem. And I think overcapacity and oversupply in so many areas from oil to steel to iron ore is plaguing the international markets. And so I try to sit back and think, well, who are the winners and losers in this environment? And I think the open, smaller global trading economies, whether it's Japan and Korea, particularly Hong Kong and Singapore, and I also think of the UK, which I believe is going to be very vulnerable now without the EU support, those are going to be vulnerable to a slowdown in world trade because they depend so much on foreign trade. The big continental economies, by which I mean the US and Canada, China, and of course India, have large domestic economies and large domestic populations which will support a consumer-led economy rather than an export-led economy. So when I look around, and China's foreign trade is about 60% of GDP, whereas India's is 12% or less. That means that India really doesn't feel the slowdown in international trade and orders from the EU and North America. So I think that the next 2 or 3 years are going to be difficult for investors, but we can find real growth and real value in some of these areas in the subcontinent, India and its neighbors.
Where are you allocating money these days, taking into account the scenario or the description that you just gave us, starting with, say, Hong Kong and China?
Well, I'm pretty cautious about Hong Kong. I think we've still got, as we did back in 97, high wages, high rents, very high property values. All of those will deflate. The Hong Kong dollar is still linked to the U.S. dollar, so it's a very expensive place to do business, as indeed is Singapore. In China, I avoid all the state-owned enterprises, all the big oils, telecoms, banks, and I focus on the special situations, which in our case we're looking at travel and tourism. We got a couple of great companies there like China Lodging, which is a hotel chain, and Travel Sky, which is the online booking agency, and education, where we've got 3 companies that are providing English language and business education to middle-class Chinese students, and healthcare. And there we've just invested in a Chinese traditional medicine company. So I think those areas where it's discretionary consumer spending will continue to do relatively well, and we see retail sales growing 11-12% in China, even though the industrial economy is flat on its back and the export industries. So I think this is still an area where you need to be very selective. But healthcare, education, and tourism remain strong.
And what sort of allocation as a percentage of your portfolio would you be making to China?
Well, we've still got around 20% in those special situations, not very much at all in Hong Kong, around 20% in India, around 10% in Australia, and the same in Japan, smaller weightings in Korea and Taiwan. We've started to buy in Vietnam. We've got a couple of stocks there, only 2 or 3%. In Indonesia and in Sri Lanka. So we're looking to the frontier markets now for, I think, value and growth.
And then you do have investments in Australia, and it's somewhat analogous to Canada.
Yeah.
What sort of investments are you making in Australia?
Well, our largest position actually is an Australian healthcare company called Nanosonics, and it makes the cleaning equipment for post-operative conditions in hospitals. And I've interviewed actually one of the top doctors in Melbourne, and he said, look, this is being adopted everywhere. 70% of Australian hospitals now have it. they're beginning to export largely into England and United States and into Asian countries. So this seems a very interesting small cap. It's about $1 billion market cap, I think. And then we also have one gold mining company as a sort of hedge, really. We had some exposure there in the period before Brexit. We had cash and we had this gold hedge, and that did very well for us. And then I've lightened up a bit since then. So it's more of a tactical position.
Now, on September 30th, you will be launching the Indian Ocean Fund, and of course that's for accredited investors.
John, it's a Cayman fund, and I think we'll start with nearly $100 million. We've got some big seed investors. It'll be 75% invested in India, mainly in mid-cap stocks. That's $1 to $2 billion sort of range, consumer, healthcare, tourism, and those kind of areas. And then the 25% will be in Pakistan, Bangladesh, Sri Lanka, and Vietnam. And that's a formula which we came up with our largest seed investor who didn't want a single country fund. And I think there is real value in these very undervalued and under-researched and under-owned Asian frontier markets, where the conditions are similar to India. Demographics is favorable, politics reasonably stable, currency stable, and growth of 20 to 25% in earnings, and you're only paying 8 to 9 times earnings in some of these markets. They are relatively illiquid, so that is why we shall restrict to about 5% in each of those markets, and India will be the main bet. And the big news in India this summer was that they passed the goods and service tax at the beginning of August with a unanimous vote in the Indian Parliament. And I liken this to the single market in Europe in '92. They basically made interstate commerce in the 26 different states of India duty-free and with no special taxes or charges on interstate commerce. And this is going to boost GDP by 1 to 2%, and I think corporate earnings by 10% or upwards. It'll take a year or two to come through, but I think it's a very important development and also underlines Prime Minister Modi's strong political position now. So we expect him to be in power for a decade, really, and really reform much of the bureaucracy, the corruption, the slow decision-making in India, which has held up so much the infrastructure development and other things.
Well, in my opinion, the Lloyd George India Ocean Fund is one that family offices and institutions should pay serious attention to, and wish you the very best with that launch. And Robert, as always, thank you for a great update, and we'll look forward to catching up again soon.
Thank you, John.
Okay, folks, we'll go to a break, and when we come back, my interview with Dean LeBaron, who is the founder of Battery March Financial Management, and you won't want to miss this interview. Stay with us. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Well, I'm joined using Skype today with my friend Dean LeBaron, who's the founder of Battery March Financial Management and a true adventure capitalist. How are you, Dean?
Very fine. Thank you, John.
You had your swim this morning?
I have had my swim this morning, and I'm going to try to have one this afternoon. Mid-year New Year's resolution is to do twice as much exercise as I did yesterday and earlier, but we'll see how long that lasts.
For our listeners, you and I are vintage characters, and we're watching the last act for us of this economic play that is going on. Now, I'm going to hand the podium over to you, and you can vent on whatever is on your mind.
I hate to say it, like Donald Trump. I'm not going to look at this teleprompters on each side of me. I'll pull some notes out from my pocket, and I won't even look at those, but let me make the message. Please pay attention. Something is going on in the world now, and I sense very much that these old boys, Bill Gross, George Soros, others, have a sense that something's going on, but they haven't the faintest idea what. And they know it's not going to be what went on just in the past. Today, for example, at 1 o'clock Eastern Time, an important meeting of Apple Computer goes on, and that's supposed to be a major announcement. I don't know that it will be. I don't know that it is, but I do know that something is cooking. We've had now for the last couple of years the markets, stock market and bond market, disassociating themselves from the economy. When I started business with you, John, way back 50 years ago, we used to look at forecasting as if they were forecasting the business of the companies that they represented. So if General Motors stock price went up, you said, I know they're going to sell more Chevrolets next month than they did this month. No, that's not true. Now, increasingly, the covariance of the stocks is separate from the economy. One case, it's a casino. In the other case, it's just sort of a no-growth environment around the world. The old smart guys, I think, like Bill Gross, say, it's just different. Relax, we'll find out what it's like in time. There's some other smart boys who say, I'm so smart, I can tell what's going on in this, and I'll apply my old tools. All I'm saying to everybody, to all of our listeners, pay attention. Something's cooking. I'm in the group that says, I don't know what it is, so I'm going to pay attention.
Well, if something's cooking and these very clever people who have lots of experience don't know which way the market's going to go, and keeping in mind that there's very little volatility right now, this is sort of the still before the storm or the exuberance, how do you position yourself?
There's several ways of positioning yourself. One, you and I are fans of hard assets, meaning gold, specifically physical gold rather than paper gold, is one way of doing that has worked well in the past. There's another way is to listen to some of the new economies that are coming along. The G20 meeting just concluded in China, where the president of China lectured the president of America, very much for the first time. And for as far as I know, for the first time, America did not lecture the Chinese about human rights. And that, believe it or not, is very indicative because the Chinese do not like to be lectured about human rights. I've been in meetings with Chinese since 1982, something like that. And all meetings would start with 20 minutes on why did you blow the head off your uncle with an anti-aircraft gun or something like that. And the Chinese did not want to be lectured on those things. That's the way they ran their country of 1.3 billion people, and that's the way they were going to it. Now, they're running it their way without putting up with lectures. The lectures are running the other way. They're lecturing us on fiscal prudence. Let's get ready to be lectured to by Chinese, perhaps. So what do we do? Is I think you do it as little as possible. If you want to be diversified and have a few equities, do so in India that you've talked about, which is perfectly fine. Probably that's more interesting than, and maybe even have some in China. But even in India, China, and the rest of the world, there's a phenomenon going on, and that is that the world's capital flows are getting stickier and stickier. The last 50 to 70 years, capital flows were easy. People moved around easily from border to cross-border. Money moved across border. Now it's getting a little bit tougher. And you and I will chuckle a little bit at this because we hear something we haven't heard of before in capital flows, and that is it may well be that they will have some new rules, but they will be applied retroactively. And in the world of law, we're supposed to apply rules proactively in advance so that people can adjust for that. But we haven't heard that expression, retroactive rules. I'm paying attention to that, and I've heard it a couple of times, and it troubles me a little bit, and it will trouble me more if I continue to hear it. But I suggest to our listeners, they worry about the word retroactive, and things can happen.
And in the past 10 days, we've heard that the European Union is presenting Apple with a bill for $14 billion of back taxes, and that's, in effect, a retroactive tax because Apple had negotiated with Ireland, and this is new information to them.
That is correct. And in this case, Ireland says they don't want it. So who's speaking for whom? I mean, as you know, I'm a lazy guy. I'm trying to spend more time, as I say, swimming in the pool or sitting under a palm tree in Florida, where my intellectual activity is to count the number of coconuts that fall from the tree just over my head. When I get up to about a dozen, I quit counting. But that's my intellectual activity. Something's going on, and it's going to be of a major form, whether we have Bretton Woods again or not, whether something happened at Jackson Hole or not. I do notice, for example, that gold went up 2% yesterday. I don't care about gold movement from one day to another, but 2% on any kind of a movement in this kind of a no growth market is worth paying attention to. So I'll pay attention to it for a while.
Now, last week I talked with my old friend John Embry, who has been in the game 50 years, as we have, and he talked about so many asset classes being overpriced. Real estate is at extreme prices, bonds are extreme prices, and stocks have been beneficiary of low interest rates because dividends have been very attractive. So there are very few asset classes that represent really good value.
That is true. I'm a bottom fisher. I try to restrain myself, however, and John is a little more forward-looking than I. I'm trying to be very suspicious about my ability to say something is overpriced or underpriced. It may well be that in the new market, the market for the millennials and the market of the next 50 years, the market that our mutual friend, Professor Nikolai Kondratiev, tells us about, is the next wave. The next time that Professor Kondratiev comes to see both of us, he may well tell us that we have entered the new season and forget about what was overpriced or underpriced in relationship to our former knowledge, and there's going to be a new metric. There was another good friend of mine, a former colleague, who's well known for regression to the mean and picking out every bubble and so forth. But he's been having trouble recently, and he's been getting very, very angry with the market. He's getting angry with the market, and he's angry with his colleague because it's not behaving the way it's supposed to. So he is expressing his anger in some uncomfortable ways. I'm trying not to be like that kind of old codger who's so sure that I know the history that I will say such and such a thing is overpriced and such a thing is underpriced. We may move to a new metric when there's a variety of other things that will determine price, and I'm trying to be open-minded to that. I must admit, thus far I have failed. I mean, I'm as hidebound as everybody else, but I'm working at it.
And it never hurts to have a little cash on the sidelines.
We are accustomed to making our investment decisions in terms of risk and return. And we've learned that, and we have fancy algorithms that do it these days in a millisecond. But there's another third dimension that's cropping up now that is increasingly more important, and that's liquidity. And it's not only cash, but it's cash that you put your hands on and walk around with. I withdrew some money from a bank recently, a little bit more than you'd get out of an ATM, but it wasn't an outrageous amount. And they said, oh, yes, Mr. LeBaron, we'll be happy to have that for you. And if you come back in 2 weeks, we'll have this cash here ready for you. Well, goodness gracious, I was quite accustomed to walking in, and they'd recognize me immediately, and they'd hand me money if that's what I wanted. This is now not the case. I've had a Swiss friend with me this weekend, and he was reminding me that in Swiss banks these days, they are behaving differently, even keeping money in a safety deposit box is a little different. In the bank that is charging negative interest rates just to hold money, if you hold cash in your safety deposit box in the bank, you are essentially holding money for a competitor to the bank in terms of it running its administration, because the cash is a competitor to the bank's form of collecting money from its accounts. So you have to be very careful. I'm attempting to be broad-minded, and I'm working at it. We're going to have new metrics for what's overpriced and underpriced, but I may be wrong.
Well, it's always a pleasure, Dean, to get your snapshot of what's going on in this world, and thank you so much for joining us, and we'll talk again soon, and have fun.
Au revoir.
Well, that's it for Money Talk. Just a few end-of-show comments. We'll see whether the Federal Reserve Board governors will continue to augur an imminent rise in interest rates. This stock market decline may have shaken them up a bit. Now, I receive a comment from John Murphy, who's a well-known technician, and I'll just give you the points that he made. He said a jump in global bond yields sent bond and stock prices sharply lower on Friday. Long-term charts continue to suggest a bottom in the 10-year Treasury yield and a bond market top. S&P 500 falls below 50-day moving average in heavy trading. The volatility index jumps 40% to a 2-month high, and the fact that we've entered a seasonally dangerous autumn period also calls for more caution. I hope that you have a